Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise. Now, this week, there has been a lot of spotlight on the US. Economic data recently has started to brighten, and Trump's tariffs face legal challenges in the courts. But bond markets, of course, showed some signs of worry about the debt implications of the big, beautiful budget bill. Now, within sort of the spotlight and these offsetting factors, where are the investment opportunities? To discuss that, I'm joined by Rajat Bhattacharya, who's a senior investment strategist at the CIO office. So thanks, Rajat, for joining us today. As we noted last week's podcast, we recently upgraded global equities to overweight, and within that, upgraded US equities to a small overweight as well. Could you walk us through the rationale behind these changes, particularly on the US?
Sure, Manpreet. Glad to be here. So, as we flagged in our recent publication, the GMO, global equities have received a boost in May from easing trade tensions and President Trump's renewed focus on his tax cuts and deregulation agenda. Now, these drivers should help revive earnings estimates, we believe, and especially lead to fund flows back into the US again. Now, this week, Trump paused tariffs on Europe, while tariffs themselves are being challenged in court, as you mentioned there. Meanwhile, US consumer confidence rebounded strongly after the trade truce with China earlier in May. Now, tariffs had hurt US equities more than other markets, which means their reversal should help US equities outperform in the coming weeks or months. Hence, we believe global equities have further upside generally, and US equities remain poised to test February's record high once again.
All right, so let's get into US equities in a little more detail. I mean, if you think about the rally in the last sort of couple of weeks, in your view, what's really driving that, and how far can this rally really go?
Yeah, so we do expect US equities to test February's record high of 6147 in the coming weeks. And potentially they could advance towards almost 6,500 over a 12-month horizon as US focused gradually turns shifts towards Trump's growth oriented policies. A US court ruling blocking many of Trump's recent tariffs has been overturned by an appeals court, which does revive some of those trade uncertainty. Nevertheless, the path ultimately seems to be leading to deals with major trade partners such as Japan, South Korea, India, and eventually the European Union in the coming months. While the Trump administration wrestles with courts on tariffs, it is keen to push ahead with an ambitious fiscal agenda. Trump's so-called Big Beautiful Bill, which was approved by the House and is now undergoing the Senate's review, will increase the US budget deficit by almost $472 billion in the financial year 2026, which is almost a 28% rise increase over the Congressional Budget Office's estimate published only in January. And they are almost 25% higher than the previous, which is the current fiscal year. Now, pressure from bond markets is likely to lead to withdrawal of some of the tax cut proposals in the budget before it lands on President Trump's desk for the final sign off, but the net impact is likely to be marginally positive for the economy. Meanwhile, US economic data has surprised positively thanks to the strong rebound in consumer confidence in May, likely after the thaw in US China trade relations. Meanwhile, US hard data has remained resilient through the trade tensions, as seen from the initial jobless claim numbers, which are averaging around 230,000 over the past 4 weeks. Now, that's well below the levels of above 300,000 of jobless claims, weekly jobless claims, that would raise concerns about a recession. Finally, I should add that the earnings projections in the US, which is about 9.4% for 2025, is also outpacing those for the euro area, which is around 6%. Now, resilient Q1 earnings across US megacaps is another major tailwind for US equities. Against this backdrop that I've just painted, it's time to reverse the sell America trade as was so popular earlier in April, even as we remain well diversified in our asset allocation.
So within the US equity market, we recently turned bullish on the US semiconductor equity sector. Can you remind our listeners of the rationale for this one?
Sure, the US semiconductor subsector was one of the victims of that sell America trade that I was talking about in April. And that's primarily because of concerns about negative impact of tariffs and trade tensions on the demand for semiconductors. Also, the sector was seen as too expensive, while China's low-cost AI model DeepSeek raised questions about the willingness of large US companies to continue investing in AI capabilities. However, recent US earnings showed the sector continued to benefit from AI-related investment. During the Q1 earnings season, the guidance from AI chip producers has been consistent with that from cloud service providers and AI developers. Both expect an increase in capex to support AI development and related demand for AI semiconductors. So we expect significant earnings growth in the US semiconductor sector. For instance, the consensus is expecting a 36% growth in earnings in 2025 and a 26% growth in earnings in 2026. Now, sales of the most advanced semiconductors are vulnerable to export restrictions from US to China, but demand outside of China is providing a strong offset. Reasoning models for AI agents are providing great demand, and that trumps the vulnerability of demand from consumer electronics and auto sectors towards a growth slowdown. Meanwhile, valuation for the semiconductor sector remains reasonable, with the consensus 12-month forward PE of 26 times, in line with two-year average of 27 times. Also, investor positioning in the sector remains supportive of a rebound in the sector.
Thanks, Rajat. So we've discussed, I guess, a lot of the opportunities, but in your view, what are the risks facing equities?
Yeah, so the continued rise in US long term government bond yields is a potential risk to the equity rally. Long term bond yields have risen across the world, most notably in Japan, as investors seek higher risk premium to compensate for long term risks such as fiscal deficits rising globally, leading to increased bond supply. Nevertheless, except for Japan, I must say that inflation expectations have remained range bound, while growth expectations for both 2025 and 26 have been cut in the US, Europe, and Japan. Against this backdrop, we believe the rise in bond yields have largely priced in the risk of higher bond sales and policy uncertainty.
I guess that begs the question then, should investors be considering buying long term US government bonds at this point?
Yes, we would use the elevated US yields to turn bullish on especially the 20 years plus US government bond sector. Those are now yielding around 4.9%. Now, yields on long dated US government bonds remain near the top of their 3 month range. Now, inflation expectations are one key factor influencing the path of yields from here. US May consumer inflation data will start to reflect the impact of recent tariff measures. Meanwhile, fiscal concerns have also come to the fore. These intensified after a US sovereign rating downgrade and recent comments by Treasury Secretary Bessent, who said that the so called X date, i.e., the moment when US government may be unable to meet its obligations, could arrive as soon as early August. Fiscal concerns are exacerbated by the budget bill, which we talked about, which is now awaiting the Senate's vote. Having said all of this, we believe these concerns, including over fiscal imbalances and default risks, are now overstated. We just believe that the long term US yields are now attractive. History tells us that governments can maintain high debt levels for extended periods without triggering a crisis. More narrowly, previous budget standoffs and brinkmanship seems more political theater than signaling an imminent risk of a bond default.
All right. Well, I think that brings us to the end of the time we have available today. So thank you, Rajat, for taking the time to speak to us. This Friday. If I can, as always, sort of summarize my top three takeaways from today's conversation, I think number one is, of course, to take advantage of the opportunity in equity markets. With a small overweight to U.S. equities amid what we still think should be an otherwise well diversified global portfolio. Second, of course, within U.S. equity markets, semiconductor subsector potentially offering an opportunity. And third, some concern on the bond market, but we think the rebound in bond yields is now creating an opportunity to add to 20-year plus U.S. bonds. So we'll bring the conversation to an end there. Thank you again for dialing into today's podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.